You've seen VOO versus SCHD 100 times, but there's one matchup almost nobody runs: VOO versus DGRO. And when you put $100,000 in each and let them sit for 10 years, something strange happens. The fund that loses on paper is the one quietly winning where it actually counts. Most people never run this comparison. They line VOO up against the high-yield names and stop there. DGRO gets skipped. It sits in this awkward middle space. Not the pure growth fund, not the fat yield fund. So it gets ignored. And that's the mistake, because the VOO versus DGRO question hides one of the most useful lessons in all of dividend investing. By the end of this, you'll see the exact moment the story flips. Quick disclaimer: I'm not a financial advisor, and this isn't financial advice. Always do your own research before making any investment decisions. Everything here is historical, hypothetical, and for learning, not a promise about the future. Here's how we're going to do this. I want you to picture two scoreboards, not one, two. The first scoreboard tracks the number on your screen, the total value of your account. Call it the paper scoreboard. The second tracks something different. It tracks the cash that actually lands in your pocket, the dividends. Call it the paycheck scoreboard. Almost every comparison only ever shows you the first one. We're watching both, because VOO and DGRO win on different scoreboards. And once you see that, you can't unsee it. Let me set the table. VOO is the Vanguard S&P 500 fund. It owns the 500 biggest companies in America: Nvidia, Apple, Microsoft, Amazon, the whole engine room. Over $1.5 trillion sit inside it. Its expense ratio is almost nothing, 0.03%. And right now it pays a thin dividend, somewhere around 1.2%. That's the key thing about VOO. It was never built to pay you. It was built to grow. The dividend is an afterthought. DGRO is a completely different animal. It's the iShares Core Dividend Growth Fund. And the name tells you everything. It doesn't just buy companies that pay a dividend. It screens for companies that have raised their dividend at least 5 years in a row, with a payout ratio low enough to keep raising. That screen quietly throws out the fragile payers and the yield traps. What's left is around 400 steady, profitable businesses: Johnson & Johnson, JP Morgan, AbbVie, Procter & Gamble, Home Depot. It yields roughly 2% today, almost double VOO, and historically it has grown that payout close to 9.5% a year. VOO's dividend has grown closer to 6%, so sit with the setup for a second. One fund built to grow your number. One fund built to grow your paycheck. They're not really competitors. They're answers to two different questions. Now let's run the 100 grand and watch both scoreboards light up. Scoreboard 1, the paper scoreboard. This is the one everybody obsesses over, so let's get it out of the way first. Over the last 10 years, going back to when DGRO was born in 2014, VOO has historically returned around 13.7% a year. DGRO around 12.2%. That's close. Just 1.5 points apart. On a single year, you'd barely notice it. 1.5 points on $100,000 is $1,500. Forgettable. But here's the trap with compounding. Small gaps don't stay small. They get loud when you stretch them across a decade. Each year, that 1.5 points compounds on a slightly bigger base, and the lead snowballs. What looks like a rounding error in year 1 becomes a 5-figure spread by year 10. That's not VOO being brilliant. That's just math doing what math does over time. Put $100,000 in VOO, reinvest every dividend, wait 10 years, and historically you'd be looking at roughly $360,000. Now the same $100,000 in DGRO, same 10 years, dividends reinvested, and you land around $316,000. So on the paper scoreboard, VOO wins by about $45,000. And if you stopped right here, you'd do exactly what everyone does. You'd say VOO wins, DGRO loses. Why are we even having this conversation? $45,000 is a car. It's a year of retirement. Case closed, go buy VOO. But that's one scoreboard. One. And here's the thing I had to learn the slow way. The paper scoreboard is the one that matters least. At the exact moment you actually need the money. The day you stop adding and start withdrawing, The number on the screen stops being the point. The cash it throws off becomes the point. So let's go look at the scoreboard nobody shows you. Scoreboard 2. The paycheck. Say Harry has $100,000 and he's deciding between these two funds. Forget the ending value for a moment. Just follow the cash. In year 1, that $100,000 in VOO pays him around $1,200 in dividends. The same $100,000 in DGRO pays him around $2,100 from day 1, before any growth, before any compounding. DGRO is handing him almost $900 more every single year. Look at it as the quarterly check, because that's how it really arrives in your account. VOO drops something like $300 each quarter. DGRO drops closer to $525. Right out of the gate, DGRO is the bigger paycheck, almost double the cash on the exact same $100,000. And that's before either fund has grown its payout by a single penny. And here's a detail that matters. Both funds pay qualified dividends, so that income is taxed at the lower long-term rate, not as ordinary income. Same friendly tax treatment, bigger check. There's no catch hiding in the tax bill. A lot of people assume more income automatically means a worse tax hit. Here, it just doesn't. Now, this is where almost everyone assumes the gap closes. They think VOO is the growth fund, so surely VOO's dividend speeds up and catches DGRO eventually. It's the obvious guess, and it is completely wrong. Watch what actually happens. This is the part nobody runs. The reveal that should be in every one of these videos and somehow never is. DGRO doesn't just start ahead on income, it pulls away, because DGRO raises its payout faster, around 9.5% a year against VOO's 6%. The gap between the two paychecks doesn't shrink as time passes, it widens. Every single year. The two lines never cross, they spread apart. Let me make it concrete. Take those dividends and just roll them forward, don't even reinvest them so you can see the raw income. By year 5, VOO's $100,000 is paying somewhere near $1,600 a year. DGRO is already paying over $3,000. Keep going. By year 10, VOO is around $2,150 a year. DGRO is pushing $5,000. Stop and really sit with that number. Same starting amount. Same decade. Same $100,000. And in year 10, DGRO is handing you almost $3,000 more per year in cold cash than VOO. As a quarterly check, VOO drops about $540. DGRO drops over $1,200. On the paycheck scoreboard, this isn't close, it's a rout. And it keeps getting wider every year after that, not narrower. So now hold both scoreboards up side by side. On paper, VOO is ahead by $45,000. On the paycheck, DGRO is winning by thousands a year and accelerating. Which one wins? Honestly, it depends entirely on what you need the money to do. If you're 30 and never touching this account, the paper scoreboard is your scoreboard. You want the biggest ending number, and VOO has historically delivered it. But if you're anywhere near actually living off this money, if you need the account to feed you without selling shares, then the paycheck scoreboard is the only one that pays your bills. And that is the entire reason DGRO exists. Here's the math that locks it together. That $45,000 edge VOO has on paper? If you pulled 4% a year out of it, that extra balance throws off maybe $1,800 a year. But DGRO is already paying you almost $3,000 more a year by year 10, without selling a single share. The growing paycheck quietly out earns the bigger paper pile, somewhere around year 5 to 7, for anybody who actually needs the income. That's the crossover nobody talks about, not the funds crossing, the two scoreboards trading places. There's one more scoreboard most comparisons skip completely, the bad years. Because how a fund falls matters every bit as much as how it climbs. Go back to 2022, the worst year for stocks since the financial crisis. $100,000 in each fund on January 1st. By the end of that year, the VOO position is down about 18%. That's a paper loss of roughly $18,000. The $100,000 is now worth around $82,000. The DGRO position, down just under 8%, a loss of around $7,900, still sitting at roughly $92,000. That's a $10,200 difference. Same money, same year, same market, and DGRO protected over 10 grand more of your capital. Why? Because DGRO leans towards steady, profitable, dividend-raising companies, with a beta down around 0.8. When the market grinds lower, that quality tilt softens the fall. And the whole time, DGRO kept paying and kept raising its dividend. But I promised you honest, so here's the catch, and it's a big one. DGRO is not magic armor. In the 2020 crash, the COVID panic, both funds fell almost exactly the same, down around 34–35% at the very bottom. The quality tilt did nothing in a fast, fear-driven drop. It only showed up in 2022, the slow, grinding bear market. So please don't expect DGRO to save you from every crash. It won't. It earns its keep in the long, slow declines, not the sudden ones. Anyone who tells you otherwise is selling you a fairy tale. So let's put the whole VOO versus DGRO picture together, because this was never really about crowning a loser. VOO is the growth engine. Over a decade, it has historically built the bigger number, and if your only goal is the largest possible pile 30 years out, that engine is genuinely hard to beat. DGRO is the income escalator. It pays you more today, raises that pay faster, falls softer in grinding bears, and after 10 years, your yield on cost, the dividend measured against what you originally put in, climbs toward 5%. While VOO sits near 2. Different tools, different jobs. Neither one is wrong, and honestly, neither one is the loser here. They're just answering two different questions about your money. And here's the move a lot of investors actually land on once they've seen both scoreboards. They refuse to choose. They split the 100,000. 50 in VOO, 50 in DGRO. Historically, that blend lands you around 338,000 after 10 years, right in the middle on the paper scoreboard, while paying you noticeably more income than pure VOO ever would.